actually claim what you think you can on your property.
The tax office can't do much now.
With the ATO scrutinising us investors more than ever, we want to make sure we actually understand the numbers.
You can only claim depreciation on that extraordinary levy that has gone to the actual building upgrade itself. So I'm actually going to go a little bit deeper into this one.
Together with property investor and accountant Jeremy Iannuzzelli, we break down the 3 stages of owning a property and how to maximise your tax deductions. We're talking the details of buying, holding and selling, helping us understand if it's an upfront deduction, over time, cost base or a complete myth.
His now new cost base is now $600,000.
A big one that I want to talk to you about, travelling to buy.
Because it is they can claim travel as a tax deduction. That is probably one of the rare ones that gets lost and not claimed anywhere within inside the return. However,
if you've often wondered about what you can and can't actually claim, it's time to cut through the barbecue talk and get solid answers around how you can maximize your tax deduction as a property investor. My name's Todd Sloan. This is the Pizza and Property Podcast, and this episode is powered by Property Developer Network, Suburbs Finder, InvestorKit, Property Strats, and Palladium Partners. More about our amazing show sponsors in the show notes below. But right now, let's jump straight into this episode with Jeremy Iannuzzelli. Jeremy Iannuzzelli, how you going, man?
Always a pleasure, Todd. Well, it's looking forward to this one today. It's going to be quite simple for some people, but for many other people, they're going to look at it and it's going to be a bit of an aha moment. It's probably one of the most important things when we are looking to go down a property investment journey, which is what is buying, what is selling, and what's holding.
And how does tax change along all of these? We're going to be breaking it up into upfront costs, over time, or at the end, which is actually called the cost base. And finally, what's actually a myth? What's the thing that someone's told you, oh yeah, just go and do that. It's all right, claim it on tax. And then all of a sudden you sit down with someone like Jeremy and they're like, no, that's terrible advice. It's the wrong advice. And we're going to be breaking this up, as Jeremy's rightfully saying, in 3 different sections: buying, holding, and selling the property. And we're going to be using a fictitious character of Nick. Now, do you want to start us off with a bit of Nick's information so we can set the scene?
Yeah, well, Nick decided that he wants to go down to the southern state of Victoria. He thinks it's a really good market at the moment. He's been pushed that way through his buyer's agent as well. Loan's ready to go. He's got $700,000 as a purchase price and he's ready to rock and roll with his purchase.
Amazing. And so he's got a wage of $125,000 a year. And so his total buy-in price, which we'll have the numbers on the screen, so just in case you're listening on iTunes or Spotify, check us out on YouTube, is going to be $182,000 because Nick's using a 20% cash deposit. He is also buying in a trust as well, which is naturally going to add a little bit more with his setup fees. Plus, it's going to change his cash flow, which is something else that we'll get into. But Jez, why don't we actually start with all of the buying expenses? We've got deposit, BA fee, because he's used a BA in this scenario, stamp duty, conveyancing costs, LMI, travel to buy the property, building inspections, and there's also building inspections he's missed out on as well. Can he claim those? Loan application fee, financial advice for setting up the trust, and then also the trust setup. Do you want to start with deposit?
So deposit's going to be considered as part of the cost base of the property. So that forms part of our capital gain tax calculation in the future. So that deposit wrapped up in that $700,000 purchase price.
All right. So we're basically talking about the cost base as in this is a deduction that kicks in after the property is sold.
Yeah, that's correct. So when we've sold the property, we've got to say, well, what our selling price was, what our selling costs were, which will include marketing and agent fees, etc., maybe styling fees as well. Then we've got to take that away from our cost base, which was the costs that were initially incurred when purchasing the property. And that's left then with our capital gain, which we apply a discount to or no discount to, depending on the time that he's owned the property.
All right. What about a buyer's agent fee?
A buyer's agency fee, this is going to sit in between the myth column and the cost base column.
Okay.
So I'll tell you why. Now, well, actually over time column as well. So it's got a 3-part section. It's where it fits in at what stage of the property investment journey that you are and what service that buyer's agent's put in. But in this particular situation for Nick, his buyer's agency fee that he's paid is part of the cost base because this is his first investment property. He has no other properties that any consultation or advice can be utilised for. So going to a property consultant or a buyer's agent, getting a bit of a property plan, a property strategy, how to make his property portfolio more profitable, what things he can do to really extract every bit of juice out of the orange. In Nick's case, it is his first property purchase, and the buyer's agent can't give any review or consultation of his existing property. So that buyer's agency fee forms part of the cost base.
Hold up a second there. So if it wasn't his first, if this was actually Nick's third, fourth, whatever, second even, how does that change things?
Well, if the buyer's agent has given some advice as part of the buyer's agency service of buying the property to really review Nick's existing portfolio, and the buyer's agent has said, well, part of our fee that we're charging you is not just going to be for the purchase of a property, but we're actually going to look at your existing portfolio.
Like a strategy session.
A strategy set. What things have you done?
Yep.
What things can you do better? What things can you improve the overall outcome, which improves your overall income, which keeps the ATO happy, because the more income that we're earning or passive income we're generating from our portfolio, the more tax that you'll pay the ATO. So the ATO are generally happy to say, hey, you're paying for this level of service. It's going to result in more income, which means more tax that you pay. We'll give you a certain portion of that fee as a tax deduction.
Interesting. Okay. So if you're going to a BA and it is property number 2, 3, 4, whatever, then do you almost want to ask, like, hey, is it possible to split the fee up if they are doing that service?
Absolutely. If the buyer's agent is giving that level of service and really reviewing and consulting on the existing portfolio to improve it, you want to make sure that within that fee, the buyer's agent is really specifying what they're providing you as a service. Very similar to if a plumber was to come in and fix a lot of things in your house, he wouldn't just put in there repairs or renovations. He would actually itemize what he has done, because some of those costs that the plumber has done for your investment property may be an upfront tax deduction, giving you a benefit which you can claim over time. Rather than him just putting in a brand new toilet, he said, well, I've put a brand new toilet and I also changed your washers in the kitchen sink. Now, the washers in the kitchen sink is a tax deduction, and that toilet the plumber's done would be an item which you would depreciate. Your buyer's agent works very much in that fashion. If they've had a really good strategy session with you to really review and consult on your existing property portfolio and giving you strategies that you can implement to be able to improve the position of your property portfolio, give the ATO more profit, more tax that you're paying, ATO will give you that form as a deduction. But where the myth lies is the whole buyer's agency fee is a tax deduction. And
do you hear this a lot?
Absolutely. And that is just simply not true. There is a service that the buyer's agent is providing you, which is going towards the actual purchase of the property. And that is done before the property is available for rent. So that portion of the cost of the buyer's agency service is a capital cost and is claimed when the property is sold.
So even if the intent is for it to be an investment property because it's not advertised for rent, what if it is currently rented?
Still not in your possession. It's very similar to like a conveyancing fee, right? A legal fee. While legal fees, while the property is available for rent, you may have to go to a lawyer because you've got an issue with the property manager or a tenant or something like that. That cost would be tax deductible in the normal course or normal operation of renting a property. But any costs that are associated with the actual purchase itself, directly for acquiring the property, like stamp duty as well, these are costs which are capital in nature and form part of the cost base and claimed when the property is sold. So the big thing is that these costs don't run away into the ether. These are actually claimed when the property is sold.
Love it. All right, let's move on to stamp duty. So he's got like $37,000 worth. It's a fair chunk. That's just going cost base? Going
to cost base. Stamp duty, although I'm going to give everyone a little bit of an exception to it, not so much for Victoria, but in Canberra, in ACT, it's actually not called stamp duty, it's called conveyance duty. In ACT, when you're charged conveyance duty for the purchase of an investment property, it is an upfront tax deduction, meaning you can claim it in the tax return.
So straight up?
Straight up.
Yeah, right.
So it is not a cost-based item because it is not stamp duty. It's very much like a lease fees. They call it conveyance duty. So generally, if you're buying your own home, you still get charged conveyance duty, but you're not going to claim it as a deduction because it is your principal place of residence.
There you go.
And for commercial properties under $2 million in the ACT, there is no stamp duty payable. Any conveyance duty that you've paid in relation to buying an investment property in the ACT is a deduction in your tax return.
Love it. All right. So not helping out Nick in this situation, but for anyone wanting to buy in the ACT, that's very good to know. Now, as far as the actual conveyancing costs then, he's paying about $1,500. Where is that coming out?
Conveyancing cost is a cost-based item. This forms part of the actual, again, cost-based calculation and claimed when the property is sold in the future.
I've got to ask, because I can already see the answer is probably going to be cost-based for a lot of this. What do you see for your, let's say, most successful clients that you work with or people with portfolios that you're like, yes, you are on the ball? How are they keeping track of this cost base? Because if you ask me what did I pay for my conveyancing for rental number one, I'm going to be honest, I don't know. And I feel like looking at this now, we keep track of it. But it didn't in the early days.
You didn't, but lucky you got married to Bianca because she does. Look, I give all my clients a capital cost-based CGT Excel because you're right. A lot of these things will get lost, especially settlement statements, which do capture a lot of this information. They do get lost. Your solicitor may retire, they may close the business, and all of a sudden a lot of that intellectual property and that information goes with it. But you definitely need to make sure that you keep in your settlement statement, which is what a solicitor or a conveyancer will provide you when the property's been purchased. Speak to your accountant though. I think they're probably the best person to give you a great summary or a great Excel of all the things you need to capture. And that will form part of almost like an estate planning procedure for you, which then you'll be able to give to your accountant or any future accountants, and they'll be able to use that to reconcile the capital gain in the future when the property is sold.
Love it. LMI, what are we looking at there?
LMI, lender's mortgage insurance, is what they call a borrowing cost. That gets claimed in the tax return, and it is claimed over 5 years, which means that we get to claim a certain portion of it until that absolutely gets amortized, and amortized means claimed in full. Little known fact with LMI, and a big one that a lot of people miss, and I do see that with a lot of new clients I bring on board, is that if you have refinanced your mortgage and have a portion of LMI that has yet to be claimed, so arguably I'll give you a good example. You were initially took out a loan with ANZ, and by year 2 you move that loan to NAB. Now, using those two banks as an example, there's no preference that I'm issuing on that statement, but the LMI that you paid with ANZ initially, what has been claimed brilliant and what has not been claimed doesn't get lost into the ether, but does get claimed upfront, meaning you get a tax deduction on the remaining balance of lender's mortgage insurance that has not been claimed already. And that tax deduction serves as a significant benefit into your tax refund. And then the new LMI, if you have paid that with NAB, that does get claimed over 5 years. So LMI stays with the loan, and the balance of it gets claimed if it's refinanced to another bank and new lender's mortgage insurance is paid.
So just to make that easy numbers, let's say LMI was 10 grand.
Yep.
And you were allowed to claim it over a 5-year period. So 2 grand a year, and you were with NAB for 2 years. So you had 6 grand left, but then you refinanced to ANZ, I think you said, or whichever other lender. So then the remaining 6,000 that you could have claimed over that 5-year period is then able to be claimed in that financial year as a whole.
Correct. So the year of which the property was refinanced and that loan was closed, in this particular case you use the example of NAB, that $6,000 gets to form as a deduction, substantially increasing your tax benefit. And any new LMI that you pay, or you may have refinanced at 80% and paid no LMI, but in this case if you have paid new LMI because you may have taken your loan up to 90% again, that gets amortized over 5 years.
Do you know the amount you can claim back as well? Is it 100% or?
100% of the LMI is a tax deduction. Now, it doesn't translate to dollar for dollar as a refund. Yep. You are only getting a refund equivalent to your marginal tax rate.
Now, a big one that I want to talk to you about, because I think I actually still get told that you can do this. Traveling to buy.
As of 1 July 2018, any travel expenses associated with residential property investment is non-deductible.
Now, I noticed you just said residential.
Residential. Now, there is a concept like carrying on an enterprise, which is cognizant with property developers who are developing property as part of being a business. Now, they're developing or flipping residential property. They're not getting any capital gain discount because it is a business, and they may be subject to GST if they're supplying new residential or substantially renovated residential properties. Then they can claim travel costs as part of the deduction of what they're doing. Commercial property is very much the same. I've got lots of clients who actually manage their commercial properties themselves. They go visit the tenant, they collect the rent, they do a lot of the repairs. And because it is a commercial property, cognizant with carrying on an enterprise, a business, they can claim travel as a tax deduction.
But they're actually acting as the PM.
They're acting as the PM. But if you're a residential property investor, like majority of us all are, any travel to our investment properties for inspection is not deductible. And really that came in, and a lot of people are guilty for it, and I can say it because it's well over 5 years ago. The tax office can't do much now, but people were trying to get really too cute while going, to Queensland or down to Melbourne to visit,
buy property in Cairns.
Yep, Luna Park in Melbourne, or the Movie World up in Queensland, and they were saying that we're visiting our property. Now it's very hard for the tax office to substantiate to say that it was only just them or not just them visiting the property, and people were taking the mickey out of the overall deduction. So rather than the tax office wasting too much taxpayer money to audit these particular costs, they just did a blanket ban across it all and said no more travel expenses for the purpose of inspecting your property can be claimed as a tax deduction.
It just makes me think of the Soup Nazi episode in Seinfeld when they're like, no soup for you. It's like, no travel for you.
That's what the tax office did. They made a feasible decision and said, not worth auditing. We'll just completely ban the whole cost.
Okay, so complete myth. So unless you're managing the property and it's a commercial asset that you've got, or you're carrying on an enterprise like a developer and it's like we're getting in, we're getting out. Essentially, it's a business.
Correct.
Like it's not an asset that you're holding as an investment. Complete myth. Next one, building inspections. Now, I want to add a little bit more depth to this as well. So we've got $800 here that Nick has spent on a building inspection. However, Nick, buying in the wonderful state of Victoria, who loves their auctions, or Melbourne more so, Nick missed out on a whole bunch, but he still wanted to do his due diligence. So can he actually claim the other 5 building inspections that he got done previously? I suppose this is almost a little bit of a 2-part question, or the one that he was successful on.
Yeah, so I'm actually going to go a little bit deeper into this one because building and pest reports, they do have many meanings and when they're getting paid and what they're getting paid for. But in short, we'll start with the ones that he was not successful on. They're deemed as a sunk cost.
What does that mean?
Sunk cost meaning that he's paid for it and there's no way of him claiming that against another property, nor can he claim that against the property that he's purchased.
Okay, because it's not a asset yet that he owns, basically,
Correct.
and it's not an investment.
Yeah, not an investment. It's not an asset that he followed through with. So it's part of the due diligence. It's the unfortunate side of sometimes when you're spending money. Very common in auctions. People that are going towards auctions, they may spend money with a solicitor to get the contract reviewed, and are not successful with buying that particular property for investment. That cost becomes sunk. It actually doesn't get claimed anywhere. It's a cost that just gets lost into the ether. So that is probably one of the rare ones that gets lost and not claimed anywhere with inside the return. However, the pest and building report, if it's sanctioned by the bank, now common for commercial properties, common potentially for people buying at 90% or plus where there's lender's mortgage insurance in there, there'll be condition as part of the loan that a pest and building report must be done and must be provided to the bank, because the bank's not going to necessarily lend you 90% of their money to you if that property's riddled with termites and you can't afford to fix the actual property. The bank's taking a huge risk, or the lender's mortgage insurer's taking a huge risk. So if the pest and building report's been sanctioned and commissioned to be completed by the bank and needs to be provided to the bank so they can review it to ensure that everything's good, then the pest and building report gets treated as a borrowing cost.
I'm not sure which one you put this in then, because then is that upfront? Is this over time?
It's claimed over time. Okay. So to me, that borrowing cost then gets claimed over 5 years and amortized.
But it's only if the bank asks for it.
It's a condition of the bank. It must be a condition of the bank because your borrowing costs are costs associated with obtaining the loan.
Gotcha.
So any cost that you've had to pay for obtaining the loan, and it's very common for valuation reports if in the commercial sector, if there's a cost that you've had to incur in order to get the loan, then that cost is a borrowing cost and it is allowed to be amortized over 5 years. So an overtime deduction. However, if you've gone and got a pest and building report for your own peace of mind to make sure you want to know what's behind wall 1 and wall 2 and door 1 and door 2, then a pest and rebuilding report will form part of the cost base. So it then gets claimed when the property is sold. So you've got to distinguish when the cost incurred, how the cost was incurred, and what was the cost incurred for or who was incurred for, and that will then determine and dictate if it's claimed over time, over 5 years, or it's claimed when we sell the property at the very end.
Does it change at all if it's one of those reports that it's like the agent done it, or there's a few new businesses now, they do it and then they sell it all to you at a discounted rate? It's exactly the same. Doesn't matter if you pay full price or you do one of those.
Yeah, again, answer comes back to if the bank's requesting, and generally this is for people borrowing 90% or plus. if the bank is requesting that pest and building report as part of their condition of obtaining the loan or giving you the loan, then the cost you've paid the solicitor or the whoever it may be, that cost will be deductible over 5 years.
Right.
But if it's not a condition of the loan and you've decided to pay that for your own peace of mind, that is a cost-based item, not lost, but claimed when the property is sold in the future.
Loan application fee. Now, this can vary. Sometimes it's hardly anything. Sometimes it's a few hundred. Sometimes we've got here, Nick's paying $1,000.
Yeah, so loan application fees are borrowing cost. Now, again, I urge anybody when you're going through a loan, you must keep your initial loan contract because there's some other fees that the bank does charge you as part of you obtaining a loan, which normally would include a settlement fee. There would be a registration fee of mortgage. Generally, that's done through the PEXA report. So you'll be able to get the PEXA report, which is a slip the conveyancer will provide you showing you where all the money went and how it was all dispersed. But in this particular case, a loan application fee would be considered a borrowing cost and claimed over 5 years because it's a cost incurred of acquiring the loan.
Now, what about the financial advice? And I purposely have this in here because our next one, we may as well ask as a whole, is the actual trust setup. Because if he is buying in a corporate trustee structure, he's going to need to actually seek financial and legal advice. So we've got down here $800 for those services.
Yep.
How's that happening?
Okay, so the financial advice is a very interesting one because it sits into the field of potentially being an upfront tax deduction. But in this particular case, the bank has actually requested the financial advice to be provided by a financial advisor. So the person who is guarantoring the loan on behalf of the trust,
Which is Nick.
knows exactly what they're doing. They know all the repercussions and the risks involved with obtaining debt inside a trust. So Nick's had to spend his $3,000 with the accountant to establish the trust itself. That is what they call a formation cost. And formation cost can be claimed upfront in the financial set of accounts and deducted in the trust itself. And the financial advisor fee, again, in relation to obtaining the loan, because if you don't pay that financial advisor, the bank will not give the authority to then issue the loan and you don't have a property or purchase him. That financial advisor fee also is considered a borrowing cost, taking a conservative view and claimed over 5 years.
Okay, so we've got 5 years for the financial advice and legal advice because the bank is asking for it.
Correct. And
So-
without it, the bank will not issue the loan.
And if the bank didn't ask for it and you just wanted to get it because you did, then totally different story.
Then you would be able to claim that as an upfront tax deduction because you're getting financial advice in relation to that purchase, ensuring that you understand exactly what the parameters are around it.
Got it. Okay. All right. So as far as buying property, is there anything that we have left out on the front end before we get into holding?
There is. So what happens generally, again, your conveyancer, when the property has been purchased, will send you a settlement statement. And in that settlement statement, there'll be these little things called settlement adjustments. Those settlement adjustments will include, but not limited to, things like council rates, strata rates, water rates, or potentially anything else that it could be considered in there, like land tax. Again, not common, but definitely been in a settlement statement in the past. Those costs are upfront tax deductions. Even though they've been settled as part of the overall purchase of the property, those costs are either you paying back the original vendor, which is the seller, a reimbursement for them paying those costs on behalf of you when that bill got paid 2 or 3 months ago, or it could be the council, whatever it may be. So it's important to keep two very special documents when you're buying a property. You need to keep the settlement statement because it will help set out the cost base. It will also give your accountant some upfront tax deductions that can be claimed. And you need to keep your loan contract. Your loan contract will specify your lender's mortgage insurance and other mortgage documentation fees that otherwise haven't been disclosed anywhere else. So if you're not getting asked by your accountant for the settlement statement or for the bank contract, these are two things you must present to them because there'll be some really good deductions you're missing out on.
Now, in terms of just general security, house burns down, something, horrible happens. Are you like on purpose keeping one of these with your accountant as a digital file, with your conveyancer as a digital file? Like how do you sort of protect against that?
Majority of these things now are all getting sent via email.
Yep.
Loan contracts, DocuSign, all those things, settlement statements. So you should most of the time, not going to say all the time, but most of the time have all these as a digital copy. If you haven't, scan them in, get them in as a digital copy. Yes, give one to your accountant. Your conveyancer will always hold these on files, or solicitor will always hold these on file for a number of years, but not forever. There is a clean out that they generally do, probably once every 5 to 7 years. But nevertheless, you should always take the initiative and have everything as a digital copy. I've got all my stuff stored in a very secure Dropbox. So that way it can be accessed anywhere around the world. I've learnt my lesson many, many times. Storing things on my desktop and my computer gets wiped out. When you're having a large portfolio, it's a big disaster.
Mate, one thing that I actually just realised I forgot, certificate of currency.
Insurance, yes, very common, very common cost. And again, banks not necessarily will issue a loan without knowing that there's security, because I think people need to understand that when you're getting a loan from the bank, you're a custodian of that property. You don't own it. The mortgage title's sitting with the bank. So they want to make sure that you're paying for their security to be protected. But yes, your insurance, when you are paying that, there is an upfront tax deduction, and you are getting that cost as a direct benefit straight away.
All right, now moving on to holding property. Now, again, if you're listening on iTunes or Spotify, have a look on YouTube, because we're going to have all of the numbers of this property actually on the screen. We're going to be going through a few of these high level with Jeremy right now to actually understand better exactly the same questions. What's up front, what's over time, what's a myth, and what's forming the cost base. So Jeremy, if I can go into the first question, mate, this is now Nick has possession of the property. It is about to be rented out. Okay, so it hasn't been rented out just yet. Let's kind of like form this story a little bit. Property management. So he's just employed a property manager, and the property manager's basically said, hey, actually, I think you should do a few renos. This is a little bit tired here. Can you just like spend 10 grand on a bit of like carpet paint, that kind of thing? Talk me through both of those. Any of the engagement fees he pays the property manager, where are they sitting with tax deduction? And also the works he's doing to the property.
So there's this concept called property being purchased in disrepair. If you have purchased a property and it, for argument's sake, is extremely dilapidated, and there's a significant amount of costs involved with getting that property up to scratch, and it could be a major renovation, then those costs form part of the cost base. It's nasty because, you know, you want to be able to get a significant tax benefit. It's a repair. I'm making this property neat and tidy to get it rented, but it does form part of the cost base and therefore acts as part of the depreciation moving forward, whether it's depreciated at 2.5 or 4% or slightly more aggressive depending on what the quantity surveyor says. So you need to make sure that if you're buying a property in disrepair and the cupboards are all fallen off at the time you've purchased it and the vanity's shot and it needs to be resealed and the floorboards need to be polished, even though that under normal circumstances potentially they could be treated as a repair and claimed as a tax deduction, that means in this particular instance from Nick's perspective, bought the property in a disrepair, and those costs are then depreciated, added as part of the cost base.
So depreciated and added as a part of the cost base.
So when we say added as part of the cost base, this is an allowable amount that is added to the cost base of the property, and then he's allowed to depreciate that cost to its full extent, which means it runs out to zero. If he happens to sell that particular property, let's say sell that property a couple of years from now, the amount that he has not depreciated, as I said, forms part of the cost base, and he gets that benefit that he hasn't claimed but spent money for as part of the reduction of the capital gain.
Got it. Okay. So, and as far as what he's paying the property manager, is that all tax deductible, or does that also come back to the whole, like, it has to be advertised to rent? Like when are the payments sort of coming out in tax deductible?
Yeah, normally the property manager's not taking a payment from you until the rent comes in, and of which at the time they're taking a payment, the property is available for rent. It may be on the market, or it may have just been rented, or it may have just received its first month's rent. So at that time when it's actually physically paid, not so much when you engage the property manager, but when it was physically paid, property was deemed to be available for rent, and therefore leasing and advertising costs form part of the tax deduction upfront in the return.
Upfront, perfect. All right. Rates and taxes. How are we looking at those? And when I say taxes, for the purpose of this, I'm going to include land tax. How do we look at those as far as upfront or over time?
All upfront costs. So they're all deductions that you can claim upfront in the tax return, and definitely should be provided to your accountant to do so.
Now, as far as your land tax is concerned, does it change like the deduction at all if it is held in a structure or if it's held in your own personal name?
No, deduction still gets claimed in the normal way. It's just claimed in the entity of which the property's been purchased in.
I'm going to rapid fire just a couple at you. Administration expenses.
Upfront deduction.
Thought so. Property insurance.
Upfront.
Gotcha. Repairs and maintenance during tenancy.
Again, if it's just repairing something back to its original status, you're not actually replacing something old for new, then they are an upfront tax deduction. But if you're generally replacing something old for new, like throwing out the old kitchen and putting a brand new one in, that's depreciated and claimed over a certain amount of years. But if your hinge has fallen off and the door's a bit crooked and you get someone in there to fix it, that's a genuine repair and maintenance, and you're claiming that as an upfront tax deduction.
Okay, where I want to try and find the line here. I've painted the cupboards, let's say, because they were all looking all tired. The doors were a bit meh, and the bench tops were looking disgusting. Maybe there was a bit of a hole, whatever it was. So I replaced the bench tops, painted the cupboards. Is that repairs or is that capital expenditure? Is that an improvement?
If you have replaced the whole bench top, that's putting in a brand new asset, which is the bench top itself, would be depreciated. But if you are painting the cupboards because the cupboards are starting to flake, then that would be a repairs and maintenance.
So when you're keeping track of this and you're sitting down with your accountant later to actually go through it, because I'm assuming you're not getting a quantity surveyor in for minor things like that. What's the best way to actually track this and also present this to your accountant? Because I'm sure there's probably people that just give you a shoebox of receipts, but like, how do you best practice this?
So you definitely got to keep all your receipts, but there's a story behind every cost. And you know, my clients are pretty good. I've trained them over the years with some really great property Excels, which kind of gives them everything they need to keep track of. And then there's a comment section. And that comment is, I want to know what it was for. Don't just tell me kitchen cost. What did you do to the kitchen? Did you replace the whole thing? Did you paint the cupboards? Did you replace the bench top? Was it just a PowerPoint that needed to be replaced? Was a certain portion of the bench top needed to be replaced? The kitchen sink was broken. You got someone in to fix it. It's important to give your accountant the story, and that story needs to correlate with what's on the receipt. If the receipt says replace whole kitchen for 12 grand and you said you just painted the cupboards, accountant's going to have a very inquisitive eye. But the interpretation of the cost, and if that cost has a useful life or it's just gone to maintain the original asset that you're fixing, whether it's the cupboard doors in this particular case, then that is a repair and claimed upfront as a tax deduction.
So as far as interest from loan, I'm assuming that is all upfront every year?
Or upfront tax deductible. And one thing there will be a package fee from a bank most likely. And again, that's an upfront tax deduction as well.
Now here's a tricky one. Because naturally, we did a bit of research before we started making this episode. Seminars and education.
Good question. If the seminar and education is directly involved for property investment and it's there to aid you and improve your knowledge around building a very successful property portfolio, and you've already got existing properties in the portfolio, then a portion of that cost can be tax deductible.
But if you don't have any property though?
Not a tax deduction, just part of your research and development, unfortunately. So you need to have the asset on the other side, which is an income producing asset available for rent for you to be able to claim a tax deduction for it. The kicker is a lot of these educational courses, you might go to a property development educational course for argument's sake, and it's got nothing to do with investment properties in the eyes of the ATO, but teaching you very new skills in the art of property development, which is carrying on enterprise. That cost would be tax deductible if you ran a property development company, but not if you just were a mum and dad investor. You might be doing online courses, which are around property investment and tax and education. As long as it's related to the increasing of wealth in relation to your existing property portfolio, a portion of it can be claimed as a tax deduction against the property portfolio, similar to that like of a CoreLogic subscription. If you're using CoreLogic to be able to research, to buy more properties and you've got an existing property portfolio and you're using it for the valuation purposes of your own portfolio, it'd be tax deductible to an extent in your return. But if you're doing an education course on how to become a real estate agent, well, while it's in the property space, it's not a tax deduction against your property portfolio.
But if you were to become a real estate agent and follow through with it, then it's going to be a tax deduction on being an agent, on the income that we produce from that?
That's a different section of the tax return.
Actually,
now.
I'm going to take us on a whole different tangent then. Okay. So as far as the actual course, it sounds like, or the seminar, it's really dependent on what information is inside it. Because
absolutely,
if it's information that helps you improve your portfolio and the way that it operates, its cash flow, its efficiency, then it sounds like the ATO goes, yeah, okay, we can see what you're doing. But you have to at least have one.
You've got to have one. You've got to have an existing property portfolio. I suppose a good example of this is the old timeshare seminars that used to be up in Queensland about 15 years ago. That is definitely not a tax deduction. Them wooing you over in a plane or in a bus to buy a timeshare in a unit in, say, the Gold Coast. 15 years ago, it's very, very common, especially from people from New South Wales. There'd be busloads of them. That's not a seminar which is helping you grow your existing portfolio. That's a seminar for someone flogging off their timeshare timeshare investments or timeshare assets.
Do you know anyone that's got one?
I have. It was very big. People who were investing in the Gold Coast about 20 years ago, Surfers Paradise, Burleigh Heads and all those areas, timeshare was very big. You bought a certain amount of time each year, 3-4 weeks, and it would swap and change. And it was huge. It was massive.
Have you ever seen the John Oliver piece on that?
No.
I will send that to you later. People can't even give them away in the States. It's a whole thing. But
it didn't last very long. It didn't last very long.
Amazing for the developers.
Absolutely. Good returns. But I think timeshare kind of moved into boats and luxury items now, which I think that's probably where it should stay.
Yeah.
Property, you want to be able to control.
Absolutely. So as far as travel costs, now Nick is going to his property. He's visiting it every year. This is now a time that he owns it. It is for rent. He's not personally managing it though, but he wants to drive past. He just wants to make sure it's okay. But he's got to jump on the plane because Nick's actually from Sydney. Anything?
Nick, unfortunately doing it purely out of the love of going to see your own property. There is no tax deduction for travel costs. And again, that rule came in as of 1 July 2018. So it's been around for quite a while now.
Okay, so that is a myth.
A myth.
All right, and lastly, something that I wanted to add into this, because Nick did buy a house. He doesn't have Strata. But I wanted to ask, what about Strata, sinking fund, all of those kinds of extra costs that go on with an apartment?
So body corp rates is a very interesting cost, and you actually need to make sure that you're conversing with your accountant. If you're just paying normal body corp expenses in the normal course of owning the property, it is a upfront tax deduction.
Okay.
Beautiful. But if a lot of these buildings at the moment, especially some older units, they're going through massive refurbs, or it could be that they've bought a new building, it's going through a massive refurb because it has combustible cladding. If the body corp gets together and there needs to be a special levy that gets raised, and for all the listeners that are listening today, it's very common. I've got many clients where special levies have been raised like $30,000, $40,000, $50,000, $60,000, waterproofing balconies, balcony upgrades, roof upgrades. The sinking fund was just mismanaged. The strata manager just wasn't doing what they were supposed to do. Maybe strata rates should have been a little bit higher. For whatever reason, they were kept lower. And then you get these one-off extraordinary strata costs. People most commonly think, well, I've got a 30 grand strata bill. It's a one-off. I can claim it as a tax deduction. It's fine. Believe it or not, you actually can't claim those one-off extraordinary items, or even if it's been put into the strata fees over, say, 10 payments, you actually can't claim it as an upfront tax deduction because you own part of the building, and that means you own part of the walkways, you own part of the recreational, you may own part of the car park. As part of your unit entitlement, you can only claim depreciation on that extraordinary levy that has gone to the actual building upgrade itself.
That seems a bit rough.
It's very rough because I've seen people, especially around Olympic Park, Liverpool's had a couple of these issues as well with a lot of unit blocks, and these are in the western suburbs of Sydney. They've had to pay all these extraordinary fees, extraordinary strata fees, and some of them have been separated over 10 fees because that's the way the committee suggested to do it. And it can't be claimed as an upfront tax deduction because it's not normal course. It's to do with the upgrading of the building as well, and it's considered a capital item and therefore needs to be depreciated. What a lot of strata managers will do is organise depreciation schedules to be done, and then that gets palmed out to all the investors who own a unit in that block. So you're not having to spend, 25 depreciation schedules. You're getting one schedule because majority of the units will have the same entitlement. If they're all two-bedders, it's only if you're a one-bedder, they may do one report for the one-bedders, one report for the two-bedders, and one report for the three-bedders. And then that way it's all shared across the people who were investors in that unit block.
And unfortunately, like Jeremy's saying, this is one of those things that if you've never been involved in it, you think, oh yeah, whatever, that's not going to happen to me. Bianca and I walked away from a deal just recently. It was this reno project. It was a little block of, I think, 6 or 8. Amazing price when we did our DD on it and found out there was a whole bunch of problems with the building, but there was 0 in the sinking fund. We're just looking at that going, this is just a special levy nightmare waiting to happen, and just walked away.
It happens more often than you think. If you are going to go down the path of owning units, and if it's not a newer unit, and even sometimes the newer units have their fair share of issues, but you've got to review that sinking fund because quite common to see that a sinking fund's probably been mismanaged. I've got a couple of properties in unit entitlements, and the sinking fund is always of contention, and it's something that I very closely look at because I know that sometimes a special levy may be coming, and that's where you don't want to be holding that property in that time because you've either got the cash or you don't, and it becomes a really tricky. And I've actually seen it present a lot of financial hardship to investors.
You're basically paying the maintenance bill for everyone else for the past 5, 10, 20 years that didn't put it away.
Correct, yeah. So you may have had people that have just recently bought into this property, bad luck for you, and you may have been that lucky one who's owned it for 10 years and sold before the special levy came in, but then everyone else is left holding the stick. So, yeah, it's one of those nasty things that come in with buying in, a unit building. You guys are all together in a strata plan, which means you are all sharing that cost if and when it comes up.
It's a big democracy. All right, mate. And let's move on to selling the property. We've got everything as far as the actual holding covered. Now, where are we looking as far as the sales are concerned? Because I'm looking at agent fees of 2%. Oh, by the way, he's also held it for 10 years. He's done smashingly well.
Well done, Nick.
Nick's now got a $1.4 million property that he's going to sell. He styled the property, $5,000, renovated it to sell. Again, the agent was like, hey, just give it a little bit of a few touch-ups around here. Spent $10,000 on it, so not full scale. He's obviously going to pay some CGT. We've got question marks there. Conveyancing cost of a couple of grand. And then I want to ask you about his mortgage discharge fees and depreciation payback. Let's start at the top with that 2% agent's fee.
So 2% agent fee forms part of the selling cost. So the equation, how it works, if you guys can picture this in your head, again, listening to iTunes and Spotify, be able to visualize it. If you're on YouTube, hopefully this pops up for you. But you've got your sale price, and then from your sale price, you want to remove your sale costs, which in this particular case will include agent fees, styling fees, might include conveyancing fees as part of it as well, because they're all directly related to the sale itself.
Yep.
In this particular case, Nick's decided to give it a bit of a renovation. That comes off the sale price as well. So what we're effectively looking at it is, Nick, what have you sold the property for net after all expenses in relation to getting this property into a position for someone to sign a contract?
Does him traveling to the property come into it when he sells it?
Unfortunately,
No,
Nick,
okay.
10 years later on, you are not going to be able to be claiming the travel costs. So
no cheap holidays.
It's always at the barbecue and it's people saying, well, I need to do it. And I know that. I do apologise. I would love to create the rules and maybe one day you can vote me in to government in 10 years' time. But until then, while I'm an accountant, not Prime Minister, you're not claiming the travel costs.
I want to ask then, is there anything that we don't have in this breakdown that sometimes people go, oh no, but it's a part of the sales cost, like the travel? I'm only being cheeky with that. You've already very well established that's not happening. But is there anything else that you find people go, no, I had to do that to sell, Jeremy? And you're like, doesn't matter. It's not claimable.
Yeah, look, anything that is directly related to selling, and that is a cost that you can claim against the capital gains. Now, a lot of people say, well, I don't want to claim that against the capital gain tax calculation. I want to claim it as an upfront tax deduction. Because with the capital gain tax calculation, you are getting that forming part of the cost base and then only getting a 50% tax deduction on it. Where if you claim it in the return against the property in full, you get 100% tax deduction on it. The classification of where they go in is actually very important and very detrimental to the overall tax calculation, because some of these costs you would love to claim it as a 100% tax deduction. In this particular occasion, it's coming off the capital gain tax calc, of which you're getting a 50% discount on anyways.
So because you're getting the 50% discount, that also means that your tax deductions go down by 50% as well.
Correct, because you would like to get the capital gain and the discount being done, and then from that be able to claim deductions 100% off that profit. So it's where it sits in the return is quite important. A lot of people want to try to push as much as they can into the return to be claimed 100% after the discount's been applied, but this is not the case.
And this is where it's so important, and why I was really asking Jeremy about how you're keeping track of this cost base. Because if Nick's had this property for 10 years, and let's just say he spent, I don't know, $5,000 a year on general cost-based stuff, then that's $50,000 that would then help offset that tax when it comes to actually selling the property. As far as minimizing that tax that he's paying, that's a huge part of that. But the one thing that I wanted to talk to you about, though, is the actual depreciation side of it. This is something that hardly ever gets spoken about. There's a payback side of that, isn't there?
There is. So there's two forms of the depreciation. There's the plant and equipment side, which is where Nick put in, for argument's sake, some new flooring. He may put in some new tapware. He may have done some major painting. There may have been some new doors that he put in. They're all things that are part of the plant and equipment. Essentially, if you can pick it up out of the house and shake it, or turn the house upside down and shake
If
it.
it falls out, it's plant and
Falls
equipment.
out, it's plant equipment.
Got it.
Anything that when you turn upside down it really doesn't, well then that's more structural.
Okay.
But any cost that he's incurred, which he has not claimed a tax deduction on, we can claim the balance of it as part of the capital gain tax calculation. So it's important that he keeps all his figures because they're things that will help reduce the CGT at the end. So Division 40, we're going to talk about the add back, and I think that's a very important because all the people at the barbecue talk about, oh, don't claim it because I had to pay it back. Not necessarily the case. If Nick in the last 10 years has claimed $100,000 worth of building write-off, let's just use that as an arbitrary number. So we'll use some big numbers here to exaggerate the position.
Yeah.
So if Nick's been able to claim $100,000 worth of building write-off, and we'll call that BW, that's presented him on average, let's call it a 40 grand refund over the space of 10 years.
Yep.
So that's gone into Nick's pocket, which has helped him pay for a lot of the renovations or repairs and maintenance costs as they came up. When he sells the property, he's got to add back that $100,000 effectively to the sale price. So he sold the property for 1.4. I'm going to make it nice and easy for everybody. He actually sold the property for 1.5. 1.4 is what he got from the person who bought the property for him, and this $100,000, which he claimed as building write-off, that actually was added back. So effectively got his 40 grand refund throughout the duration of the 10 years. Now that 100 grand building write-off, we essentially take that away from the cost base. So if you remember, Nick initially bought that property for $700,000, but during the duration of that 10 years, he claimed $100,000 of building write-off. So his now new cost base for this particular purpose is now $600,000.
Okay.
So when we're doing the CGT calculation, effectively what we're saying is, well, $1.4 million was his sale price. Again, we'll call the other costs all part of the 1.4. Less his $600,000 cost base. In this particular case, he's actually made $800,000 as a capital gain.
Okay.
Because that $100,000 that he claimed as part of the building write-off comes off the cost base. Effectively, he's now adding that back.
Yep, I'm with you.
Now, we get a 50% discount on that $100,000 because that $800K now gets discounted to $400 grand, of which he now pays capital gain tax on at his marginal tax rate. So instead of him getting $40,000 as a refund now on that 100 grand, which he had accumulated over the last 10 years, that actually nets off to being $20,000 refund.
Okay, so this is where you're saying that the advice at the barbecue of, but you've got to pay it back, don't do it, is basically wrong because of the amount that you're actually being deducted over the years versus how much you're paying back later on?
Correct. So you've got $40,000 throughout the 10 years, and then when you're having to add back that building write-off, we've got to take into account that 50% of that add back goes into our back pocket as cash, and the other 50% of that add back now goes into our tax return to pay tax on it.
Not to mention, this is a 10-year scenario. If this was a 30-year scenario, then we're also talking about 30 years ago dollars versus today's dollars.
And that's the big thing. What's that dollar worth 10 years ago compared to today? And we all know that the dollar's always going to rubbish because the more they print, the less valuable it becomes. So I would love to take a bit of an interest-free loan, use that money in today's terms, and then be able to pay that back to the tax office with a far substantially depreciated dollar.
Love it. All right, so as far as the rest of Nick's situation, if I just scoot back to it here. So his depreciation payback we've just gone through. CGT I feel like we've just gone through. His renovation, selling, styling, all of that is all part of the sales cost. His conveyancing is going to be the same. His mortgage discharge fees, they're in the sales cost as well. Is there anything at all that you're seeing people try and claim that they can't?
Yeah, not necessarily, but as I said to Nick before 10 years ago, keep your settlement statement, keep your loan contract. Same needs to be done where you keep your settlement statement for sale and you keep any loan or discharge statements you get from the bank. Don't throw them away because I know it's tempting, because there are some costs in there which are represented as whole numbers but not necessarily specified in the settlement statement or the PEXA reports.
Okay.
So there could be add backs of council rates or water rates which will change your tax, probably sometimes for worse. But on the other side, there'll be some fees when you're closing the loan which can be claimed as a cost against the capital gain as well.
All right. So all in all, we're looking at a few myths, the major one being travel. We're looking at so much of this actually coming to form the cost base, which is like now us, who cares? Future us, going to be so thankful that now us actually did care. But it would be so easy to actually just kind of forget about it. So I think one of the biggest takeaways I personally want everyone to take from this is keep track of your cost base, because you could so easily, and I did not track all this, and Jeremy is right. I'm so lucky that I have Bianca, because Bianca now tracks all of this really, really well. I was just running around all ADHD, just doing stuff all the time. Whereas keeping that track, future Todd and now future Bianca are going to be very, very happy with it. As far as the BA fee, it sounds like there's some variation in there depending on exactly what they're actually doing. Is it strategizing? Is it not? But you have to already have a property.
Absolutely.
Education, same kind of deal. There's a little bit of nuance to it, but you need to have at least one property for that to even come into the tax deductible side of things. Stamp duty, that's your cost base unless you're in the ACT.
Then it's conveyance fee, and you can claim it as an upfront tax deduction.
Happy days. Repairs and maintenance, by the sounds of things, there's a few little fine lines in that, but realistically, if you're replacing it, it's cost base. If you're painting it, if you're sort of freshening it up, you're changing the screws, the whatever, then it can form part of your upfront because it's your repairs. Special levies, yeah, unfortunately, that's just bad. Like this, that is not upfront. And just, I want to say a big one with that, do your DD properly. Like investing in units, especially high rises, already not really the best idea. I'm going to go so far as to say it's a terrible idea to invest in a high rise. However, there are some units, sometimes it can be a deal, might not be the best idea, but it's the worst idea if you don't do your due diligence and you've got a complex that's got a massive amount of problems with no sinking fund. You're going to become the sinking fund.
Absolutely.
And then all of our sales fees, they're all getting wrapped together. But there's a little bit of nuance here as well. You're saying that it's better sometimes to actually, if you could, get it off of your upfront deductions, but that's not necessarily how it works. This is also part of the cost base, the CGT discount.
That's it. So some of it needs to form part of the capital gain tax calculation, but ideally we'd love some of these expenses to come after the CGT calculation's been done, but that's really the conversation you need to have with your accountant to ensure that you're doing everything compliant.
Mate, what is the action step here? Because I feel like it's keep track of your cost base, but what do you want to make sure everyone can pull out their headphones and put into practice straight away?
Yeah, substantiation. If you're doing the 10 minutes every week, and one of the biggest things I've learned as an investor holding a large portfolio is I really get my wife involved. She does a lot of the bookkeeping in the back end, and some of the staff are involved as well. But I'm tracking things on a monthly basis. I know exactly where all my costs are, and that way nothing's missed. I do a little bit of a review just to see how the properties are performing on a month-by-month basis as well. It's very important. Estate planning is key, and the only reason why I really stress that you've got to keep all the documentation and ideally put it into soft copies or digital copies is estate planning purposes. If you pass away, your accountant and your solicitor will become filthy rich on it because your spouse, your family, they have no idea what's going on. You may have not been as transparent with it, haven't created an estate planning folder. They've got no idea how to track things. That's where the professionals get involved and make a truckload of money. So you want to be in a position where someone can pick up your life if you're not there to tell them what's going on, and you can give them a perfect little summary and say in the space of 10 minutes of exactly where things are, what it exactly cost you, and this is the tax that you may need to pay if you do sell it. And that's one of the biggest things that a lot of people don't. They leave this earth and they pass away there with their problems, and that means that the generation next has to pick it all up, and it's going to cost them an arm and a leg. So have all this documentation being prepared, because tax does not run away when you pass away. Tax is then passed on to the person receiving your assets, and when they sell it, they pay the tax on behalf of that asset.
And that's something that I've actually got to talk to you about. And I recently did an interview with Jeremy's dad, which I don't know if it's going to be live first or if this episode's going out first. And it was something that your old man actually pointed out, that I do not have a will and I need to sit down and create a will because, and the biggest reason I'm being so open and vulnerable about this, because from what I understand, so many people don't. This is way more common than it should be. And I want to know if something does happen to me that B's taken care of, or something happens to both of us, Fred's taken care of.
Absolutely.
So, yeah, you and I got to talk about that once we push stop on the recording. But, mate, we've arguably come to the most important question of the entire show. Jeremy Iannuzzelli, I've asked you this before, but I'm going to ask you again. What is your favourite pizza?
Any pizza without anchovies on it. I know you'll probably hear my father talk about what his favourite pizza is, but I am going to say anchovies are a no for me.
They do kind of taste like cat food, but it's weird, man. I used to hate them with a passion. I've started kind of liking them. I haven't had a pizza with your dad yet, so...
If you and I have a pizza and there's anchovies, I promise I'll pick them off and put them to the side for you.
Mate, thank you so much for this episode, because I know there's a lot that goes behind this. And obviously there's just a lot of general knowledge that you're like the ChatGPT of the property accounting world, mate. I ask a question and an answer comes out.
And I think even quicker than ChatGPT sometimes.
Yeah, it's taking a moment to think now. It even says that. But Jeremy Iannuzzelli from Pradium Partners, thank you so much for jumping on the show, mate.
Thank you, Todd.